What's up, guys? This is Casey, and welcome back to the channel. So today we're going to be discussing the markets. Things have been very, very volatile over the past few weeks, and we're going to also be discussing what's going on today in terms of news, which is pretty much the Microsoft earnings. So let's just kind of jump right into this. Microsoft reported their earnings after hours today, and they were actually pretty positive. So on Microsoft's site, actually, if you take a look at their earnings, their revenue was great. They met that. Their operating income there was met. The net income was met. For the most part, everything was positive. But a really strange thing happened after hours. It dropped. And people are wondering, well, why would it drop if actually it was after hours? And the reason being is that there were some concerns about the forward guidance. Well, luckily, what occurred is that after this dropped, Microsoft came out with their forward guidance about, I think it was half an hour later, and pretty much Microsoft said, yeah, we anticipate, not a lot of crazy headwinds, and we're gonna continue to make money, which is very, very surprising. So when this happened, pretty much the stock rebounded all the way back. Microsoft was actually down up to 7% after hours, and then it actually rebounded and got bought all the way back to actually finish a little bit over 1% or so after that. So it's just really, really crazy stuff. Now, showing you guys something here. Let me actually show you this chart. You guys can take a look at that. Sorry, wrong chart. So taking a look at Microsoft chart here, you can see, it had a nice red day, which it's a bad red day, if you will. And then take a look at the 5-minute. Sold off, and then it popped back right after hours. So that's positive. Now, in terms of what's going on in the overall market, it's just been crazy. And the reason being is that if we go all the way back here to the start of the pandemic, you guys will notice something. This is the time frame that the Federal Reserve said that they were going to start the quantitative easing. Now, something that we weren't sure back in this time frame is exactly how quantitative easing was going to be received by the markets, particularly Wall Street, right? Because this was at the beginning of the pandemic, and so we're like, well, okay, granted, all the money's in the economy, but who cares if people aren't spending money and everyone's home and shut down? And we just didn't foresee this having a very positive effect. But to the contrary, it had an amazing effect. So the Federal Reserve pumped in a ridiculous amount of money to the economy. Not only did retail, individual homes get it, but businesses got it. Apple received tons of money if they agreed to keep certain employees on board and not, lay off as a result of the pandemic. So just companies got ridiculous amounts of money. They got so much money that even if they had bad earnings, it didn't matter. Because every time there was earnings that were just subpar, stocks just continue to go up and up and up and up. And you guys can see that get reflected, right? Earnings pop, a little here, a little dip down here, pop, and nothing got affected. Same thing with Google, right? Every earnings didn't matter, up. This is just all the federal monetary policy, all of the easing. Same thing with Microsoft. We had a historic bull market. But what's going on now? Well, look at this here. Microsoft is down to 200. Google is breaking past the 200. Apple hasn't got there yet, but I think it's going to get there. The SPY as a whole, which is the S&P, is past the 200. Now, it really isn't hard to do because it had pretty much been trailing the 200 moving average all the way, all the way up for the whole, bull run. But we're finally seeing a significant breakdown. Now, what has changed? I'll tell you what's changed. The Federal Reserve back in November, I believe, stated that they were going to start monetary tightening. And so they pretty much said, hey, the fun ride is over. All the money we gave you guys, all the money we pumped to the economies, all the investment money, all you guys' businesses, all the hedge funds, we are stopping it. The free ride is over. So all the cheap money that you guys are allowed to borrow, time to reel it back in. And so the Federal Reserve has now started their quantitative tightening to where they now start, they stop their bond purchases. And so when the Federal Reserve does their bond purchase, what they're basically doing is they're buying government bonds that are, over a 10-year maturity date. And then they basically, by doing that, they pump in a bunch of money. But the opposite occurs with quantitative tightening, is to where they stop buying the bonds, and so and they do the opposite. And so what happens is that it takes money out of the supply system, which then causes businesses, specifically hedge funds and investors, to freak out and then start pulling their money out as well, because there's less money into the supply chain. Now, keep in mind that during this time frame, the Federal Reserve increased the U.S. debt by like over $1 trillion. Like, the amount of money that they pumped into the economy to get to this point was so historic that we may, I don't want to say never, but we may not see this again for another 20 or 30 years. It's a good and bad thing, because they had to do it to keep the economy propped up. But the downside is that if they continue to do this, a gallon of milk would be $13. So right now, inflation is around, they say 7-8%. I actually think it's a little bit more than that, to be honest. But inflation is really high. Normally, it's around 1.72% a year. It's now 7-8%. So what that means is that if you work a 9-to-5 job, you need to have gotten a 7-8% raise just to make the same amount of money that you were making last year. That's what inflation does. And so we've been on this train for 2 years now, and now the Federal Reserve has said, no more. So they are doing their tightening. They are basically stopping their purchases. If we take a look here, got the wrong link. Here we go. So pretty much here, the Fed has said that they're going to stop. So I'm just pulling up a quick CNBC article here, and they said that the ultra easy monetary policy is done. So they're going to be now buying back $60 billion worth of bonds, which is less than what they were purchasing prior. It's actually half. And then they're going to continue to reduce their bond purchases all the way until they say that they may be done sometime in March. Now, what's also probably causing this is that the Federal Reserve said that they actually planned on finishing their the bond purchases in actually June of this year, so in 6 months, so the second quarter. But they are aggressively expediting this because of how over hot the economy is running in terms of inflation. They know that if they don't get a handle on this fast, things are going to continue to get out of hand, and rents, cars, everything's going to continue to go up. People can't afford it because salaries won't match the crazy inflation, and then things can get even worse. And so they see this, and now they're trying to correct it. Now, the challenge with this is that they may end up making a mistake to where they may overcorrect. But I think that they're probably not as concerned about that, is because there's so much money into the supply system that really have to do this to get some of that out, to get things back to normal levels. Let me show you guys something here that I actually, quite honestly, I got caught in. I knew we were going to have some pullback, but I did not expect this. So I actually purchased some Netflix a few days ago, and I'm going to share this with you guys. So I saw this here, and I'm sharing this with you guys because I want you guys to make sure, and just to show you just how severe this Federal Reserve pullback is. Take a look here. Netflix, we know it's a runner, right? We know it's the industry leader in terms of streaming television. And take a look here. Pulled all the way back from $700. It didn't touch the 200 moving average. I knew that was not going to happen because that's just not how the algos work. I thought it was going to then run through the 200. Yep, that occurred. I saw this. Normally what happens here is that we get a bounce, usually, right? Because a lot of the algos like to trade over and under support levels, I've noticed. And so I knew this was going to happen. But then what I thought was going to happen is that we were going to get a retest of the 200. And so I actually put a very sizable position on here. And the market makers knew that everyone probably was looking to try to get that pop up, at least just for a day or two. And we did not get it. Still didn't get it. Oh, may get it there. Oh, may get it there. Boom. Ridiculous. Netflix dropped 20% after hours on this. Just absolutely bananas. Let me show you guys something else that occurred with another top stock. Amazon. Same thing. High stock. High up here is 3,700. And it's kind of falling. And then here we go. And you know what's going on right here is Amazon has not reported earnings yet. right? So typically something like this in the regular market, you would think, okay, great, this is a good time to buy. It's significantly oversold, 3,700 down to 27. I mean, any other market, you definitely buy this, right? I mean, this is it's over 20% down, damn near 30%, 25% down. You want to buy this. The problem is that if you do purchase Amazon right now, you are going to likely get caught into a bull trap to where it may gap down because we have seen to where Amazon's earnings are slowing. Their growth is slowing. And that has been a concern that investors have had over the past year or so. Even with all of the pandemic money that the Federal Reserve has pumped into the economy, things are slowing. And that's been a trend for Amazon, which is insane to think about it, considering how big they are. And so, very same pattern right now. We have Netflix that's been hit. We have Amazon that's getting hit, that's getting smashed. And so, typically I would expect a company like Amazon to have excellent earnings. I mean, how can you not? I'm on Amazon every day. I don't know how much money I spend at this on the website, but it's a lot. But because we know that there's a lot of monetary tightening that's going on right now, and if we take a look at where this stock was originally back in the pre-pandemic days, what are we looking at? 1900, and it's at 28. I mean, we still have quite a ways to go. And so I am not bullish on any stock right now. Let me say that to you guys one more time. I am not bullish on any stock right now. I am not purchasing any additional stocks right now. I'm not purchasing any pullbacks. None of them. And the reason being is because, one, I got caught very heavy in this Netflix. But not only just that, you can't let, if you're performing excellent or pretty good or solid position sizing, even a huge drop like this shouldn't make it break you, and this one did not make it break me. It's just a significant gap down. But the reason I'm not is because I have finally been made aware of just how powerful the Fed is. When they say they're going to do something, the markets respond extremely heavily to what the Fed is going to do. Not only that, we have the FOMC meeting that's coming up tomorrow, and they are expected to announce and confirm that they're going to kick off some additional rate hikes for this year as well. So not only do we have the Federal Reserve, who is actually performing monetary tightening right now, right? So they're pulling all this money out of the economy, but then in addition to that, the Federal Reserve is going to be raising rates. So that means that not only is there going to be less money into the money supply for businesses and investing and investment companies and hedge funds and all those big financial firms, but to borrow money is going to be expensive as well. So I'm sure you guys know this, or if you don't, banks borrow money from each other. It's called the federal rate, the prime rate, and they get, and I don't know exactly what it is, but it's an extremely low rate. It's like 0.25% or 0.5% that they can actually borrow hundreds of millions of dollars from each other. And then they take that money and then they lend that money to us, the consumers, based on our credit scores, based on the rate that they get. And so when the Federal Reserve says, hey, we're going to pump in all this money to the economy, they're basically telling the banks, take this money and what do you do with it? You invest it, lend it out, and then that's why, rates have been so cheap and so forth. But that's over with. And the Federal Reserve has made that very clear. They're not hiding it. They are not, doing this in secrecy. They are openly stating, just like they did down here, when the market crashed, that when they said, hey, we're doing monetary easing, and they said, hey, we're doing monetary tightening. And so because we know that they're going to continue to, stop the buybacks all the way into March, and they're going to be raising rates, they're actually talking about doing an additional 3 rate hikes. Well, then you can best believe that means that we're going to have higher interest rates this year. It's coming. They've told us. It's not an accident. It's not a surprise. And so this is not the time to buy stocks. It just isn't. If anything, I will be taking some short positions. Actually, I know this sounds really crazy to do this, and I want to actually try to keep this video condensed because I have a lot more to talk to you guys about in our other videos. But I actually may take some short positions on Apple, which sounds absolutely absurd. But just all of the flags right now pointing to Apple being the next stock to have a pullback, and maybe it comes back to 123, maybe even comes all the way back to 113. I don't know, but I do think we can have at least a 144 pullback. I'd like to see how Microsoft does, after these positive earnings, see if they actually hold or if they actually continue to see if it sells off over the next few days. But as of right now, if I am taking any kind of positions, it's going to be a short position on Apple or Amazon. I never thought I would say that. I think those are the two top companies, some of the two top companies on the planet. And so to be crazy enough to short them, I mean, I have to really be bearish. And right now I am. In March, April, May, once things start to cool down, once the markets start to actually pull back, will my sentiment change? Absolutely. But, you have to be smart and go with the flow. And so until then, we'll just keep eye on the markets. I will continue to make videos when we have these crazy market moves, or if anything significant happens or that catches us by surprise. And that's it. So hopefully you guys found this video very informational. We reviewed Microsoft's earnings today. We talked about what occurred, what we think is going to happen. We also went over the SPY, just to kind of talk about, the direction that we think is going and my sentiment in terms of the overall market. So if you guys found this video informational, found it entertaining and helpful, do me a big favor, hit the like, hit the subscribe, and if you really liked it, leave a comment. That's what I really know you guys appreciate it and you like the content. If you haven't already, been to the channel, this is a financial education channel, so we talk a lot about finances. A lot of videos are going to be based on how-tos, did you knows, things such as talking about credit, obviously the stock market, investing, things of that nature. And that's pretty much it. So if you guys have any investing questions, feel free to leave your comments below or questions below, and I will be more than happy to answer them. Until then, happy trading. Talk to you later.